3 market crashes, 3 different decades, 3 completely different reasons the market fell apart, and every single time, the same 5 types of investments either held steady or went up while everything else bled. The dot-com crash, the 2008 financial crisis, COVID, the pattern repeated each time, and once you see it, you can't unsee it. In this video, I'm going to show you exactly what those 5 categories are, the specific ETFs that belong in each one, and how putting just $10 a day into this portfolio could grow into over $400,000, paying you more than $1,000 a month in dividends. But first, the pattern. During the dot-com crash, the S&P 500 fell 49% over 3 years. Internet companies that were trading at insane valuations just disappeared. But consumer staples, the companies that sell soap, toothpaste, and groceries, returned 11% a year during that same stretch, while the broad market was losing 22% annually. These boring companies were making money. Same economy, different assets, different results. Fast forward to 2008. The banking system nearly collapsed. The S&P lost 37% in a single year. The biggest banks fell 80% or more. But long-term treasuries, basically 20-year loans to the US government, returned almost 34% that same year. That's a 70-point swing versus the S&P. If you held both, one cushioned the other. Then COVID hit. March 2020. The market crashed 34% in just 5 weeks, the fastest crash in modern history. And again, the same playbook showed up. Gold returned 25% for the year. Healthcare stocks went up 18% as money flooded into vaccine and treatment companies. Consumer staples finished the year up over 10%. 3 crashes, 3 decades, the same 5 categories catching the money every single time. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, here's what makes this tricky. Picking the right category is not enough. The wrong fund inside the right category still loses you money. So how do you filter down to the 5 that actually survive? The 3 filters. Meet Diane. She's 58, a teacher in Ohio. She's got $185,000 saved in her 403(b), and she's terrified of what comes next. She's watched 2 market crashes wipe out her colleagues' retirements. One colleague was 2 years from retiring in 2008. He lost 40% of his portfolio, had to keep working until 68. Another pulled everything into cash during COVID and missed the entire recovery. Diane doesn't want growth stocks. She doesn't want speculation. She doesn't want to gamble with money she can't replace. She wants income, she wants protection, and she wants a system she can trust. So she builds one. 3 filters. Every single fund has to pass all 3 before it touches her money. Filter 1 is cost, the expense ratio. That's what the fund charges you every year just to hold your money. 0.25% sounds like nothing, but over 30 years, the difference between a cheap fund and an expensive one is tens of thousands of dollars. Diane cuts anything above 0.5%, period. Filter 2 is track record. The fund needs at least 10 years of real data, and it has to have lived through an actual crash. Not a simulation, not a backtest, a real crash with real panic selling. If a fund hasn't been tested by fire, it hasn't proven anything yet. Filter 3 is size and liquidity. That means the fund has to have billions in assets under management and millions of shares trading every day. Why? Because small, thin ETFs get crushed during panic selling. There aren't enough buyers on the other side. When everyone runs for the exits, you want to be in a fund where the door is wide open. After running every candidate through all 3 filters, dozens of funds get cut. 5 survive. And the first one is the foundation. It's where 40 cents of every dollar Diane invests goes. The 5 ETFs. Number 1, SCHD. The Schwab US Dividend Equity ETF. This is the foundation. 40% of every dollar goes here. It holds about 100 large US companies that pay reliable dividends. Names like Coca-Cola, Procter & Gamble, Texas Instruments, and Verizon. To make it into this fund, a company has to be profitable, have a strong balance sheet, and have at least 10 years of consistent dividend payments. No exceptions. The expense ratio is 0.06%. That's practically free. The current yield is 3.29%, and the dividend has grown roughly 9% a year over the last decade. Here's the crash test. In 2022, when the S&P lost 18%, SCHD lost just 3%. That's the power of owning companies that pay you to hold them. Number 2, VHT, the Vanguard Healthcare ETF, 30% of the portfolio. The logic is simple. People don't stop getting sick when the economy tanks. They don't stop taking their medications. Hospitals don't close. Insurance companies keep collecting premiums. Revenue stays stable. Earnings stay stable. Stock prices follow. VHT holds over 400 healthcare companies. In 2008, it lost about 23%. Painful, but the S&P lost 37%. During COVID, VHT actually went up 18% while the broader market was bleeding through the fastest crash in history. Number 3, XLP, Consumer Staples, 10% of the portfolio. These are the companies that make the stuff you buy no matter what. Soap, toothpaste, groceries, toilet paper, Coca-Cola. You're in a recession, you still need to eat. Your job is on the line, you're still washing your hair. In 2008, XLP lost just 15%, less than half what the S&P lost. Recession-proof by design. Number 4, GLDM, Physical Gold, 10%. Now, Diane uses GLDM instead of the more popular IAU. Same gold in the vault, exact same exposure, but GLDM charges 0.00% versus 25%, half the cost for the same asset. Over 30 years, that saves thousands of dollars. Gold pays no dividends. It doesn't grow earnings, it just sits there. But gold returned 25% in 2020 and roughly 64% in 2025. It moves opposite the dollar, and the dollar always weakens during a crash. Gold isn't there to grow your wealth, it's there to protect it. Number 5, TLT, Long-Term Treasury Bonds, 10%. This is the most controversial pick in the portfolio. TLT returned 34% in 2008, the most explosive hedge in modern markets, but it lost 31% in 2022 when the Fed raised rates at the fastest pace in 40 years. That's why Diane keeps it small, just 10%, enough to catch a rate-cutting cycle, not enough to drag the portfolio when rates rise. And while you wait, it pays 4.5% a year in income, the highest yield in the portfolio. 5 ETF portfolio. All 5 expense ratios are under 0.25%. Every fund has billions in assets. 80% sits in defensive equities, 20% in pure crash hedges. Every fund passed all 3 of Diane's filters. Every fund proved itself in a real crash. So, that's the portfolio. But here's where most people get the math wrong, and it's the difference between a retirement that works and one that falls short. The honest projection. Before I show you what this portfolio actually grows into, drop a comment right now. What's the one thing that worries you most about retiring into a crash? I read every single comment. Diane puts in $10 a day. That's $3,665 a year. She reinvests every dividend. She doesn't touch it. She doesn't check it every morning. She just lets compounding do the work. Now, I'm going to be straight with you. Some videos project 10% blended returns on a portfolio like this one. That's not honest. This portfolio has 20% in gold and treasuries. Gold pays no income. TLT has averaged negative 7.5% a year over the last 5 years. Those positions protect you during a crash, but they drag the overall growth rate in normal times. The realistic blended return for this portfolio is 7 to 8% a year, not 10. Here's what that actually looks like for Diane. Diane's 30-year projection, $10 a day. By year 10, Diane's account would hold roughly $52,000 to $57,000. The dividends would be generating about $1,200 a year. Not life-changing yet, but the compounding is just getting started. By year 20, the account would be sitting between $170,000 and $205,000. Dividend income that year, roughly $4,000. That's over $300 a month, and most of what Diane has at this point isn't her own contributions anymore. It's the market multiplying every dollar she put in over the previous 2 decades. And by year 30, Diane's portfolio would be between $400,000 and $460,000. The dividend income alone is $10,000 to $12,500 a year. That's $850 to over $1,000 a month paid out for the rest of her life, on top of Social Security, on top of any pension she earned as a teacher. Now, that's lower than some projections you'll see on YouTube, and I'm okay with that, because these numbers survive a bad decade. They survive a crash. They survive the reality of a portfolio that's built for protection, not speculation. I would rather give you a number you can trust than one that sounds impressive but crumbles the first time the market drops. But there's one more thing Diane does that most people skip entirely, and it's the reason her portfolio actually survives the crashes it was built for. The portfolio only works if Diane doesn't panic sell during a crash. That's the real hedge. Behavior. Think about what happens if Diane sells TLT after its 31% loss in 2022. She locks in the loss permanently. She misses any rebound. The hedge she paid for never gets the chance to work. That's like buying home insurance and canceling the policy the day after a storm. Or think about what happens if she stops investing during a crash. She misses the cheapest shares she'll ever buy. The best month to invest is the month everyone else is too scared to. The shares Diane buys during a crash are the ones that do the most work over the next 30 years. Here's the myth. A crash-proof portfolio means nothing ever goes down. Here's the truth. It means when something goes down, something else goes up, and you never have to sell the thing that's falling. That's what the 5-piece structure gives Diane. In 2008, her stocks would fall, but her treasuries would explode upward. In 2020, her gold would surge while equities recovered. In 2022, her dividend stocks would hold steady while treasuries dropped. Every crash has a different shape, but the portfolio always has a piece that's winning. Smart retirees don't build portfolios that never fall. They build portfolios that never force them to sell at the worst possible time. You don't need a portfolio that never falls. You need one that never forces you to sell. If someone you care about is worried about retiring into the next crash, send them this video right now. It might change how they see their entire portfolio. And drop a comment below. Which of these 5 ETFs are you adding first? And are you investing in a taxable account or a Roth? I want to know. And if you want to see what happens when you pair this crash-resistant portfolio with 3 growth ETFs that all beat the S&P 500, that video is on screen right now. I'll see you there.